Would you buy this business with more than £3 million of cash sitting in the bank for £8 million? The business is doing around £5 million in revenue. It's making between £600,000 and £800,000 a year in profit, and it owns a property worth around £1 million. So, is the business actually worth £8 million? Is it even possible to finance a deal like this with no money down? And what mistake could completely distort the valuation? Lots of questions to answer. So in this video, I sit down with a fellow business buyer to break down the numbers behind this deal and see what it's really worth. But please note, all important identifying details have been omitted to protect the confidentiality of the buyer, the seller, and the company involved. So here's that conversation.
So you've got help sense checking offer on a potential purchase, help sense check funding structure for the purchase, and thoughts on overall deal. So let's start off with the first question to help sense check offer on a potential purchase. Do you want to ask your questions, explain the deal, explain what type of company it is and so on?
Yes, happy to. So this is a company that produces HVAC accessories, and also it's currently doing revenues of anywhere between 5 million and almost 6 million. Okay. And seems to be, quite profitable, I'd say. Gross profit margins are about 35% on average. And net profitability is net profit before tax is between 600 and 800,000 pounds.
Okay, so it's a nice profitable business, which is good.
Yes, it is a nice profitable business.
Yeah. So, how did you find the business?
Via a broker.
Okay.
Yes. Right. So I'm at the point where I think for the first time I actually started used AquiCalc, and I found it quite useful. Got confused at some point, and there's still things I don't fully understand how it works. And so I took some things from there and then tried to do my evaluation outside of AquiCalc, because much simpler.
Okay.
Yeah.
Well, that's not good.
No, not simpler in the sense that AquiCalc is quite robust. Okay.
Yes.
And at this initial levels of the conversation, because I've had meetings with the owner of the business, and I've had meetings with the broker and the owner of the business, and we had 2 sessions so far. Got along really well with the owners of the business.
Brilliant. Okay.
Yeah, their expectations.
So you've got a good rapport going, which is
it's got a good rapport going. Yeah, the broker is constantly trying to insert himself in between, but anyway, their expectations in terms of seems quite on the high side, on the steep side.
What price are they? How much are they asking for the business, Victor?
So the business has got the property the business trades from is valued at £1 million. Was valued at about.
So they own the property.
They own the property in the business, so the business owns the property, and that's valued for about £1 million. They've got circa 2.7 million in the bank, and they've got another cash investment of about £750,000. So they've got circa 3.5 million cash in the business.
Okay.
They want £8 million for that.
Now, so they want 8 million to include the property and the cash, or
yes,
or they want 8 million and they take out the cash and the property.
They want.
Just to be clear, what we're saying here.
That's a very good point. Now, because I had the meeting with, I insisted on a face-to-face meeting over Zoom with the broker and the business, because I always like to engage with the business, get a sense of them, etc. And the business owner, the broker was talking in multiples of EBITDA. And my problem with that was, their information memorandum did everything they could in the book to make the EBITDA bigger than it really should be.
That's brokers for you. They do that, yeah. Okay.
And so they did not account for various deductions that are legitimate deductions, including rent for the property, because when someone buys it, they need to pay rent for the property.
Absolutely. Well done.
Yeah, payment, payment for a manager when the owner goes away, and little things, and quite justifiable deductions. So while the broker is talking in multiples, he wants 5 to 6 times multiple.
Yeah.
The brokers of the EBITDA. Now, question of what EBITDA is, I really need to sit down with him. It's not going to be his EBITDA, whatever that is. But 5 to 6 still sort of seems high for me. And then I pressed to say, right, let's give it a number, right? No point saying 5 to 6 times of of what? And the owner of the business basically said, I want 8 million, right? That's what it is. So he wants 8 million pounds. So he's in his thinking, he feels he's got about 3.5 to 4 million pounds in cash in the business, which he intends to take out.
Okay.
And then there is the 1 million pound for the property, which brings it about, say, 5.5. Is that correct? No, it's about has 3.5 plus 1 million, which is 4.5 million. And then the rest of it, he thinks, should be the enterprise value of the business itself, right? Which is about 3.5 million extra.
I'm just going to do the numbers on my phone here, just make sure. Yeah, so if we take off the £1 million of the property, let's assume that's the correct value, 2.7 million in cash and £750,000 investment, that leaves us 3.55 million for the actual operation, the business itself.
That's right. Yeah.
So if we took the lower of those profits, the 600, without any add backs or rent or anything like that, because I haven't got those numbers in front of me, but you divide that by, let's say, £600,000, that would be a 5 to 6 times multiple, which is kind of where the broker's at. But of course, that whether it's 600 or 800, there's going to be things taken off and things added back on. So we'll need to take off the rent, because they're selling the property out of the business. You've got to have a property to trade from. Is he taking the property out of the business and then renting it back to you? Is that what's happening?
No, the owner wants to sell everything. He wants to sell the property and he wants to sell the business with the property.
So he wants to sell the property to you?
Yes.
As part of the business?
As part of the business, yes.
Right, okay.
Yeah.
Which in fact is probably a good thing, because we're going to come on about structuring the funding, but you've got an asset there that you can leverage because it's a good security. It's still asset finance, so you could raise money against that, which would be a good way of raising some money for the business. So that's good. So I think sounds like a good deal, to use the word sense checking it. However, the two sides of let's deal with the 3.55 million. The cash is one thing. Well, there'll be need to have some of that cash as working capital cash. So all of that 2.7 million of cash, there's got to be an amount in there that is not excess. So you'll need to be left with some cash in the business on close, I always argue. But that's a debatable thing. But let's leave it at 3.55. So I think you're where you're negotiating, assuming you're happy with £1 million for the property, but you'll have to have that valued, of course, and the cash and the investment. It's really negotiating the 3.55 million at the end of the day, isn't it? And then how that's financed.
Yeah, that is correct. Yes, that is correct. That's exactly correct. Because when I do, carry on, please.
Yeah. So in terms of looking at how you finance that, have you even? I presume you haven't even entered into discussions about that, because how I always see it is you can't start working out how you finance something until you know what you're financing. So you need to hone that at the end of the day. And I think the best thing that you can do, he's put forward his figure of 8 million. I guess at the end of the day, you've got to come up with what you think you would want to pay for that business. In other words, your valuation. And where did you get to with that yourself when you worked out that your profit that you're going to multiply, and what kind of multiple are you thinking? Where did you get to?
So I started with my adjusted EBIT, okay?
Yeah.
Without depreciation and amortization, because a few of the equipment includes vehicles, right? And vehicles you need to change pretty much almost every 5 years, and those vehicles are actual haulage vehicles, etc., for delivery and go. So I came in at I think it was about 2 times multiple. My number was 5 million, including the property, just like they came up with 8 million. I was willing to go up to 5.5 million. But they were not happy with that, and so if you want to improve the offer, we're happy to have a conversation. But where I am at the moment, they don't think that that's gonna work for them. The EBITDA, if I was to work with my EBITDA based on what Aquical provided, the EBITDA is about £721,000 as at end of year 2025, okay? And Yeah, if I did the multiples for that, it's at 3 times EBITDA, that's 2.1 million enterprise value. Okay.
Yeah.
And my working capital calculation, okay, which says that the business pretty much holds about 2.2 times of the monthly revenue is tied up as working capital. So I'll give you an example. So the annual revenue for 2025 was 4.6 million. The monthly revenue divided by 12 is 385,000 pounds. And when I did the working capital by subtracting current liabilities of about 843,000, the current assets of about 1.7 million, he gave me a trade working capital of about 878,000 pounds.
Okay.
And so if I divide 878,000 pounds by the monthly revenue of 385,000 pounds, I have about 2.2 times the monthly revenue as working capital. So in reality, I would be expecting them to leave working capital of close to £1 million. So if I came in at 3 times EBITDA, that's about £2 million, 2.1 million.
Plus the property million, so that comes to 3.1.
Yeah,
plus the excess cash. What would that excess cash be once you worked that out?
The excess cash would be about 3.5 million.
Okay, so you're at now 6.6 million versus his 8 million. All right?
Yeah, that would be about 6.6 million. Yeah, but without taking out working capital, yes.
No, sorry, the 3.5 cash, was that including the working capital?
Yes, that is without subtracting the working capital.
You're not subtracting the working capital. It would be only the cash element of that you'd be subtracting, because you're buying the working capital, which is including stock and trade debtors, less trade creditors, is part and parcel of the business. The only element that you want to subtract from the cash is that working capital cash that you've got. That makes sense?
No, I don't. No, I'm lost. Yeah, I'm lost. Right, I think it's the working capital. So
is this the AcquiCalc calculation?
No, this is not the AcquiCalc calculation, because
okay.
I was lost about how to populate the AcquiCalc calculation in this regard. So what I simply did, so if I just talk through what I have here, calculated enterprise value at 3 times EBITDA of 2.1 million. Okay?
Yeah.
Then I calculated net debt. Okay. And net debt is a sum of cash of 2.7 million.
Yeah.
Short-term investment of 765,000.
Yeah.
Less corporation tax of 184,000.
Yeah.
And then less long-term creditor, of about 52,000 pounds.
Yeah.
And so net debt came to 3.2 million pounds.
Okay. So far, so good. That sounds good. Yeah.
Okay. Now, I then went away and calculated working capital. Now, to arrive at the equity value, I then did enterprise value of 2.1 million.
Yeah.
Plus net debt of 3.2 million.
Yeah, agreed.
Less working capital of, call it, I did 900 and something thousand. But
why are you deducting working capital?
That's what I thought. That I don't know. I thought that's how you.
No, you don't deduct working capital. When you're buying a business on a multiple of profits, that multiple, in this case, whether it's the 2.1 million doesn't actually matter, includes that working capital. So it includes trade debtors, stock, less your liabilities. That's already included within that. You're already buying that within the value. You don't take it off of that. That's how the multiple works. Does that make sense?
Yeah.
That's the working capital and how it's working is part of the actual business. I don't know whether you're getting confused. What will or could happen is you set your normalized working capital of, let's say it was £878,000. And then on takeover, if your working capital is higher or lower than that, you can make an adjustment on the sale date. So if all of a sudden stock went up a lot or went down a lot, you would make an adjustment for that. I don't want to confuse your make this complicated, but you don't deduct net working capital from your valuation.
Okay.
Does that make sense?
Yeah, that makes sense so far. So if I do not deduct my working capital,
No.
That would mean equity value would be 2.1 million plus net debt of 3.2 million plus property of 1,050,000. That leaves me at about 6.4 million pounds.
Yeah, that sounds right. The only adjustment that I would say that I was talking about is there'll be an element of that cash that is excess cash, because normally a business is bought net of debt and net of cash effectively, but you'll need some cash in the business on day one, and it's working out what that is, and you'd have to agree that with the owner. But let's ignore that for the minute.
Okay.
So you're at 6.4 million and he's at
8 million.
The comparable to that is 8 million.
Yeah.
Has he seen your number, or have you put forward your number?
No, I haven't. The last number
that's fine.
Was about 5. I think I was up 5.5, but we haven't gone to this level of detail.
That's fine. Okay. So before you do that, I think the thing that you need to do, and we can talk about this now, is let's assume for a minute that he accepts your 6.4 million. Have you worked out how you would fund that?
Not quite. I had worked out how I could fund it at 5 million.
Okay.
5.
And how would that? Let's go with the 5 million. And let's see. So the 5 million would be funded how?
So my thinking was the 5. So out of the 5 million, obviously he's got to take out the cash, right, of about 3 million.
Yeah.
Which leaves a balance of 2 million.
Yeah.
1 million is the property, which can
you can finance that. Yeah.
Finance that, and so that leaves a balance of 1 million, which I was hoping we could reach an agreement to get some seller finance on that, and and pay that off over a period of time.
That works. However, I think in reality the 5 million probably won't.
Okay.
Because, well, it may work. I mean, at the end of the day, what you've got to decide is the number that you're comfortable with putting forward. And I think when you calculated your 5 million, you've taken off your working capital, which is incorrect. If we then went with the 6.4, so you got 6.4 million, less your property. Well, let's do it the other way, less your cash of 3.2, wasn't it?
2 million, yeah.
3.2 net, your net debt 3.2. So you're now with 3.2 million, of which 1 million is a property. Let's assume you could borrow 70% of that. So you can borrow
70% of the property, yeah?
Yeah, the property. So you've got 3.2 million, you can get 700,000 of that property. Yeah.
Yep.
So you're 3.2 minus 700. So you've got 2.5 million to finance. What's on the balance sheet asset-wise?
Asset-wise, it's fairly asset-light. The total fixed assets in the property is at about, give me one sec, 1 million. Let me just get the exact.
Well, that's not light. That's quite a lot. Do you think there's any asset finance in there?
No. The reason I said light is because that includes the property. Tangible fixed assets less the property is about £300,000.
Well, it's not to be sniffed at. There's £300,000, and it's about getting finance from different places. And the good thing about the property and other asset finance, you can use that as the initial upfront lump payment to the guy. So you're keeping the balance of whatever you end up with as the seller finance angle. You probably realize that asset finance doesn't work off of what's on the balance sheet. But, well, it'll be work out what's on the balance sheet, but not what the balance sheet says. The asset financing company will say, what are these assets? What are they worth? And we will lend you 6%, 70% of that. I think when you're working it out, be conservative. And let's say they're worth £200,000 and you might get 60% of that.
Okay.
200 times 0.6. So that's 120 grand, let's say.
Okay.
As one option. Now I think you said it's got trade debtors of 1.3 million.
That's correct. Yeah, it's got significant.
Yeah. Who is it? What type of customers? I presume that it's B2B, right?
It's B2B. Yeah, this is B2B.
Now, invoice financing is potentially controversial, and it can go both ways. It can be expensive, but equally it's a good way of raising finance. And you have to think about how it is perceived by the clients of the business. But you could potentially raise up to about 85% of that 1.3 million.
Okay.
Let me do that. I can't do that in my head. That's times 0.85. And that's 1.1 million.
It's about 1.1 million. Okay.
So invoice financing, well, let's call it a million.
Okay.
So now we had 2.5. Hopefully you're keeping with me here, Victor.
Yes, I am.
So we had 2.5 million minus 120 for the asset finance, minus £1 million of invoice financing. We're now down to 1,380, which you could do perhaps on seller financing.
1.380.
Yeah. And this is where AquaCount will come into its own, because you can plug all these in there. Because the thing is, the key to this is making sure it's cash positive with all of these numbers in there. Yeah. You know, we've just done this. Bexy, we've effectively done this on the back of a fag packet type of thing, without working out how that impacts cash flow. And what you can do with the seller financing is to work out the period over which that would work to fit in with the business and what's acceptable. And the reason I'm saying this is that you haven't agreed a number yet with the seller, so you don't know exactly what you're going to be breaking down the financing. But what I didn't want you to do is go forth with a number without properly thinking about how to finance it. Because if he turned around and said, yeah, I'll accept that, it's unlikely straight away. But if he said, yeah, I'll accept that, and you thought, oh, I've now got to think about how I finance that, at least we've given that attention, we've worked it out so that it structurally works. Now, let me throw something else in. Let me throw something else in there. Okay. Because I know this works because I did it myself. Even the deal didn't go ahead, I know it worked. It didn't. I think it's that civil engineering business that I nearly bought, but someone else came in and offered quite a lot more for the business, while I'd got all this finance sorted out, and the guy went with that deal. Okay. But what I'd done was, I didn't own the business. I organized the asset finance, which in this case you can do on the property and on the other assets on the balance sheet before you own that business. Okay. With his blessing, of course. And all of that could all be paid on completion. So that would all work. And you can even raise the invoice financing when you don't own that business. I know it can be done because I did it.
All right, before you even own the business, okay?
Correct. Now, the thing that you need to find out, but this is key. Okay. There's two elements to this, and what you need to boil down to, ideally with you face to face, you're not cutting the broker out, he'll get his fee. You want to get with the seller. Okay. There's two things. What does he want versus what does he need? What does he need right now? Because it's in his interest this business works, particularly if there's a seller financing aspect to it. Now, coming back to the invoice financing, that's controversial for a number of reasons. One is expensive, but if it gets you the deal and the business can afford it because it's cash flow positive. But secondly, it can upset customers. I say upset them because factoring companies can be a bit more aggressive on collections. So you have to be aware of that. So you can, let's assume you can agree a deal between you and say, look, this is how I'm looking at financing it, blah, blah, blah. One aspect of it was, I was thinking of doing invoice financing. However, this is expensive. And this is where it comes down to what you need right now. So we can get him the 700K for the property. It'd be easy to get him the 120K or whatever it ends up being with the other asset financing, and say, well, if you don't need that £1 million that I would get from invoice financing, if I add that to the seller financing, and instead of paying the factoring company that money, we don't upset the customers of your business, which you and I have got a vested interest to make sure this works, I will pay you higher than you would get if you're putting that money in a bank or wherever you invest it. So, for example, if he was going to stick it in that £1 million in a bank, he might get 4 or 5%. Whereas if you go to a factoring company, you'll have factoring fees, you'll have interest to pay on the amount outstanding. And if you add all that up and say to him, look, I could pay you, let's say 7%, he's never going to get that at the bank. So he can make more money out of the sale. And this is where the rub could come as well. Now, some people may disagree with this, but you could say, well, okay, to sweeten the deal for you, I could pay you a little bit more for the company. So instead of it being, what do we say, 6.4,
yeah,
you could increase that a little bit to encourage him so he's getting more money, albeit spread over time on the seller financing. But I think the crux is to get down to what it is he needs. If he says, I need, let's say, 2 million quid right now, you've got to work out how you can get him 2 million quid. But if he says, well, actually, I don't need whatever the amount is right this second, but if you can sweeten the deal for him, A, pay him the interest you would have been paying to a factoring company, making him be the bank,
yeah,
and that ticks two massive boxes. One, it helps you buy the business.
mm-hmm.
Two, it shows how confident, of course, he is in that business. And you've said you've already built up a good rapport with the guy. So he already starting to know, like, and trust you, because he would never lend you that amount of money if he didn't trust you. He needs to trust, A, that you're going to pay him, and B, that you can run the business. Now, he wouldn't still be talking to you if he didn't think the latter. He probably doesn't necessarily know about the seller financing aspect yet, which is fine, because you don't want to be I always use it, I can't remember, I've told you about this, but if you were dating, you would never ask someone to marry you on your first date because they don't know, like, and trust you. Seller financing is like asking someone to marry you, in my opinion. It's that kind of, it's the intimate part of the relationship. They've got to really trust you that you're going to pay that back and you're going to run the business because it's the business paying that back. Thoughts on the overall deal? Well, HVAC I would say is a good sector. Sounds like a cracking deal if you can get this one over the line. But I think the important thing is that you keep looking for other deals. Don't be a motivated buyer. If you get to a point where you say, right, okay, this is the deal that I'm putting on the table. If he says no, you've got to walk away, but leave the deal on the table.
Okay.
I remember one deal when I left the deal on the table, 6 months later, they came back and accepted it.
Okay.
And that's the beauty of having a lot of deals in front of you. You're probably already a little bit emotionally involved in this because you've met the owner, you've started to go down the route of what that'd be like to have that company. It's exciting, but you've got to be in the point where you're not just reliant on this one deal. You've got another deal to look at that you are comfortable to walk away. Okay?
Yeah.
And one of the biggest reasons buyers struggle to walk away from deals like this is because they don't have a strong deal pipeline. When you only have one opportunity in front of you, it's easy to become emotionally attached to the deal, which is why finding off-market businesses is so important. Watch this video next, and I'll show you how to find businesses that aren't even for sale yet, and deals that other buyers don't even know exist.